Okay, let's jump right into this explainer. If you've been looking at your sheets lately, you've probably noticed massive engagement with alternative asset classes. For a long time, alts just meant crypto or, fine art, the wild west of finance. But today, we're looking at a complete structural metamorphosis in the financial landscape of May 2026. This is a fundamental shift in exactly how the world's biggest institutions process, price, and actually trade geopolitical volatility.
And nothing shows this better than this number right here. Kalshi just hit a massive, and I mean literally massive, $22 billion valuation. This comes right after a $1 billion Series F funding round. But the truly staggering part, the timeline, that represents a 100% appreciation in exactly 5 months. This isn't some slow, organic buildup of retail guys downloading an app. No way. This is an aggressive institutional land grab.
Because here is the brutal truth of the matter. Institutional volume on these platforms just surged 800%. And it's not because Wall Street suddenly wants to gamble on the World Cup or pop culture. They're using this as a highly sophisticated risk management tool. They are actively hedging against massive, binary geopolitical events, specifically things like the ongoing 10% Trump tariff appeal.
So, here's our roadmap for today. We'll cover the $22 billion alternative, retail bets versus pro hedges, the alpha gap arbitrage, hedging the 10% tariff, depth, slippage and resistance, and finally, the institutional event economy. Let's get right into it.
Starting off with Section 1, the $22 billion alternative.
To really grasp what's happening, we have to completely change how we talk about prediction markets. We aren't talking about speculation anymore. We're talking about dynamic geopolitical insurance. This has become an absolutely core component of modern equity portfolio management. It's all about delta-neutral hedging against macro-regulatory shocks. Think about it. Say you've got a portfolio heavily weighted in import-dependent tech stocks. A sudden tariff ruling could just completely wipe out your quarterly earnings in a matter of seconds. Traditional financial instruments, they can't always protect you from a sudden binary legal ruling like that. But these event contracts, they step right in to fill that void.
Now, looking at the major players, Kalshi absolutely dominates the domestic space. Why? Because they offer U.S. institutional FDIC-insured accounts and they are fully CFTC regulated. But Polymarket didn't just sit on the sidelines. Actually, they executed a brilliant $112 million regulatory shortcut by acquiring QCX. This let them slide right back into the U.S. market as a regulated exchange. And get this, that move was backed by a massive $2 billion strategic investment from ICE, the Intercontinental Exchange. When you have the parent company of the New York Stock Exchange throwing billions your way, that's a giant neon signal of institutional trust. It proves this infrastructure is being built for Wall Street, not for retail gamblers.
Which brings us to Section 2, retail bets versus pro hedges.
You have to understand the massive alpha gap in how these two groups operate. Retail traders, they treat these platforms like a Vegas casino. It's all about all-or-nothing directional bets, just hoping to double their money. But the professionals are playing a totally different game. They use them to construct delta-neutral positions. If you trade options, you know delta is your rate of change exposure. If one single geopolitical headline can crash your stock price by 5% instantly, that is a terrifying rate of change risk. So the pros are essentially buying a highly specific protective put to neutralize that exact exposure.
It really comes down to behavioral finance. Losses just hurt way more than equivalent gains. Studies actually show people usually need a potential $250 upside just to stomach risking a $100 loss. And as investor Monish Pabrai points out here, Wall Street gets confused between risk and uncertainty, and you can profit handsomely from that confusion. The pros aren't guessing. They're calculating implied probability versus market sentiment.
Let's look at exactly how that math works in Section 3, the alpha gap arbitrage.
Okay. Here is the fundamental golden rule of binary contract. Every single question pays out exactly $1 if it resolves as true. Because of that, the price of a contract is literally the market's direct estimate of implied probability. So if it costs 42 cents, the market thinks there's a 42% chance of it happening. But what happens when the sum of the yes contract and the no contract drifts below a single dollar? Well, a risk-free arbitrage opportunity is mathematically created. This is where market efficiency gets tested in real time. Let's see this in action across platforms during a Fed interest rate decision. Over on the U.S. heavy Kalshi, they're pricing the yes at 68 cents. But the globally driven Poly market,
They have the yes at 55 cents. So high-frequency automated systems instantly pounce on this sentiment gap. By buying the yes on Polymarket for 55 cents and the no on Kalshi for 32 cents, the trader spends exactly 87 cents to guarantee a $1 payout. It's literally risk-free profit no matter what the Fed actually decides to do. They're just capturing the spread between two different localized market sentiments.
Moving on to Section 4, hedging the 10% tariff.
Let's step away from arbitrage for a second and look at a real-world scenario. Imagine an institution with a $100 million baseline equity portfolio, and they're facing a massive, non-linear threat, the ongoing DOJ versus Trump tariff ruling appeal. Now, we are totally impartial on the politics here. We're just looking at the math. If that tariff is upheld on appeal, they calculated 10% hit to their holdings. That's a $10 million loss. Right now, the prediction market yes contract for the tariff being upheld is trading at 40 cents. So the multi-million-dollar question is, how many contracts do they actually need to buy to become completely delta neutral?
Well, the math requires absolute precision. You take your estimated loss, $10 million. Then you divide it by the net payout of a winning contract. Since the contract costs 40 cents up front, the net profit when it wins is 60 cents. So $10 million divided by 60 cents means the trader has to purchase exactly 16.6 million yes contracts to perfectly offset their equity risk.
And this beautifully illustrates the brutal truth of professional hedging. Let's look at the outcomes. If the tariff is upheld, the core portfolio loses $10 million, sure, but the prediction contracts pay out $10 million in pure profit. The net result? Zero. You're completely safe. Now, if the tariff is struck down, the portfolio is untouched, but those contracts expire worthless, costing the firm roughly $6.67 million. The key takeaway? Paying a $6.6 million insurance premium is vastly superior to taking a devastating, completely unhedged $10 million hit. But to do that, you need the right environment. Section 5, depth, slippage, and resistance.
Think about it. To execute massive trades, like buying 16 million contracts, institutional market makers need profound liquidity depth. You can't just dump an order that big into a thin market without totally ruining your own entry price. And Pantera's research lab data reveals a really fascinating structural difference here. Polymarket actually possesses 3.5 times the resistance to price movement compared to Kalshi. Because Polymarket pulls from this massive, global, decentralized liquidity pool, it takes 3.5 times more capital to shift the probability percentage. So for institutions trying to enter block trades in the tens of millions without suffering massive slippage, that global depth is an absolute game changer.
But don't count Kalshi out, because they fight back exactly where it counts for traditional finance: speed and safety. While Polymarket's decentralized network processes global political news about 3 to 7 seconds faster, Kalshi has direct institutional data feeds that give them a 2 to 4 second latency advantage on domestic Federal Reserve events. In the high-frequency trading world, that latency advantage is an absolute weapon. Plus, Kalshi offers regulatory safety, FDIC insurance, and a 4% APY on parked capital. That is a massive incentive for large funds to just keep their cash sitting ready on the platform.
Which brings us to where this is all heading. Section 6, the institutional event economy. We are literally watching the vertical integration of the event economy happen right in front of us. Robinhood is acquiring MAXDX so they can build out their own CFTC-licensed infrastructure. Coinbase bought the clearing company to internalize event settlement. And maybe the biggest signal of all, regulators are actively evaluating event ETFs. If a regular mom-and-pop retail investor can suddenly trade an event ETF in their standard Vanguard or Robinhood retirement account, the liquidity pipeline is going to explode exponentially. Because of this, experts are forecasting this sector will expand into a $1 trillion market by 2030. Yes, trillion with a T. The line between a speculative bet and a vital portfolio hedge? It's officially gone. We're witnessing the birth of a unified theory of event-driven finance. Information, insurance, and investment have all kind of dissolved into this single, high-speed ecosystem where every single major macro decision is priced, traded, and hedged in real time. That $22 billion stat we talked about at the beginning, it isn't a peak, it's a foundation. So, I want to leave you with this final, provocative thought. As the information economy achieves total institutionalization and Wall Street prices every single geopolitical headline down to the millisecond, as prediction markets integrate into the very fabric of global banking, what risk are you leaving unhedged? Are you actively managing your uncertainties, or are you just playing the odds? Thanks for joining me on this explainer, and I'll catch you next time.